and welcome to this edition of the Diwali Samvat series on the Wealth Formula. I'm Mahalakshmi and I have with me Jigar Mistry from Buoyant Capital. Jigar, thank you so much for joining this morning. The topic you have agreed, the blockbuster conversation we are going to have is Bach ke rehna re Baba. So let me start with this. There are very few times in the market where you can really throw caution out of the window, and COVID was perhaps one of those opportunities. But otherwise, generally, you have to be cautious in markets. But today, given that, last 15 months, you've seen absolutely flat markets, earnings have come down. They're on the path to recovery now. Domestic flows are fairly strong. The market seems to have taken tariffs on their stride. Why would you say we have to be cautious?
Hello, Mahalakshmi. Thank you as always for inviting me. Diwali special. Looking forward to having a conversation with you. Why would you say you need to be? So, if you sort of break it down into 3 or 4 large blocks, then I will say, the tariff-related issue is one block which you need to see. The second is the policy level shifts in India that are currently underway and how that plays out once the shift is fully done. So what started with a few state elections took momentum in the central budget and then crescendoed around the GST cuts. Now the implications of these are something that we need to keep in mind. There will be a lot of benefits from those as well, and that we need to keep in mind. The third bucket, I would say, is basically how the flows sometimes appear to be driving the fundamentals rather than it being the other way around. And the fourth part is when you sort of join it all together and bring it to the state of the market, the general area of caution should be around the amplitude of the wave around the mean. What I mean with that is that, increasingly post-COVID, you are seeing, the markets react in a way where things are great. People are extremely optimistic. When things go bad, people get completely despondent. And there is a lot of information that's flowing around, but not enough insight. And that is causing the volatility around the mean. And that is something we need to keep an eye out on. So I would say these are the 4 things. We can discuss it in any order of preference you want, or I can sort of run you through our key thoughts and then we can expand on those.
Yeah, I think, we should break down all these 4 things. So first, tariff, because the market seems to have really taken it on its stride. They think that this is a transitory phase, more likely that in 1 or 2 quarters, this will, the tariff situation will change. And the quarter of the market that is affected will obviously rebound. What is your thought? Is it contrary to what the market is assuming right now?
Not really, Mahalakshmi. So, see, when it first got announced around February or March, we were evaluating this from almost 2 very distinct possibilities. One is what the market seems to be talking about now, which is that this is a job-owning tactic to get a lot of countries to a negotiating table. The average tariffs in the US at the time were around 2%. You threaten 25, 30, 50, 100% tariffs. And that has resulted in the average tariff rate going up to somewhere around 15, 16% today. And that was what the intended consequence always was. Right? So this is one part of the situation we were talking about. The other alternative, which was what if there is a deeper ideological thought behind what was happening? Initially, it looked like there was some sort of thought behind this because Dr. Stephen Moran, who was then the chair of the Council of Economic Advisors to the White House, and today is one of the Fed governors. He had written a memo when he was in the private sector about 6 months ago or so, and there 6 months before February, that is. And he was arguing something which was completely different from how US has been known to do the business. The central point of thought he had was that, the dollar is extremely overvalued. The reason it is overvalued is because, US must run very high trade and fiscal deficit. Why it must run high trade and fiscal deficit is because every country wants to save in the US dollar. And therefore, it is incumbent on the US, or I think if I get the words right, he said it's like a structural debt on US to keep supplying those dollars so that other countries could invest in dollar. The way in which you would go about doing this is to have everything offshored, run very large trade deficits, and get everything manufactured outside of US. The problem, according to him, the way we read that was that this creates a dilemma, which we club it under the Triffin dilemma dialogue, which is that essentially this leads to a situation where you have a continuous supply of the dollar and continuous supply of the dollar. And at that point in time, the more of a commodity you supply, the lower its value gets over a period of time. And therefore, you were into a situation where on one hand, you want to keep the sort of trade deficits high. On the other hand, you want to keep the supply high. And that creates a confusion, which is what US was trying to avoid. His prescription to this problem was that let's get all manufacturing back to the US. Let's get manufacturing back to the US, and then not near shore, not friend shore, onshore everything. And you're trying to undo almost 35 years of China, of US being a singular reserve currency, and almost 23 years of China-led disinflation. And should we go there, we would have been thrown into uncharted territory. The path we took to determining where we are on those two items was basically that how much time individual leaders have, right? So say if you are Trump, your scheduled end of the presidency is in January 29, but in November 26 you have the midterm polls when all the 435 seats of the House and 33 of the 100 seats of the Senate will be up for re-election. So on the outer side, you have like 12 months, 13 months, which means in the next 6 to 8 months, you would want to sign and seal every deal there is to be had. On the other side, the main adversary is China, and Xi Jinping doesn't operate on electoral cycles, right? In fact, in March 2018, he removed the maximum two-term presidency limit for any president, which means he's now the president of the country for life or state of the head. But he's not just the state of the head, right? He's also the head of the party and head of the military commission, all the three for more than a decade. No other leader in China, not even Mao Zedong himself, was all three for longer. So an argument can be made that he's arguably the strongest leader in China. The Politburo is staffed with all his loyalists. He can think 20 years. Trump has to sign everything in 6 months. And eventually, Trump will certain way give in. India was a collateral damage in the entire process. At the macro level, it's not a very difficult problem to solve, right? Because you export like 2% of GDP, and half of that is taken out for 6 months. You still have like a 50 basis point impact to contend with, which is 1 month worth of work. We shut down in COVID for longer, so clearly we can handle that. What's not handleable is the micro level impact, because gems and jewelry, textiles, they get impacted. And rupee dollar may go for a spin if the current account deficit increases. So there's some amount of work to be done there, but we are with the street in believing that eventually, you will have a resolution to this, and sooner looks like more probable than later.
So you're saying the primary risk from a market perspective is the rupee dollar?
To some extent, rupee dollar is because
gems and jewelry, if you look at the gems and jewelry and textiles, of course, textiles, some kind of optimism got built in after the UK FTA, but then it's substantially corrected. So in that sense, that is not a quarter that is showing in any kind of optimism at this point in time. To risk to prices is just that it might languish for some time if this doesn't reverse. What is the risk from all of this for the main street, in the sense bulk of the market?
From a tariff-related issue, Mahalakshmi, we don't think there is a huge risk for micro industries per se, because eventually they need the stuff. There are very few places from which they can get it. So at a slightly higher cost, they'll deliver it. And given the margins that these companies operate, I don't think you will have a situation where they'll be able to absorb a lot of costs. So eventually, US will have to pay for it in terms of higher inflation directly. Uh, where we think some amount of risk stems from is the fact that you are running slightly elevated current account deficit now. The FII outflow has been negative. The FDI on a net basis has been negative as well. Now, should we not get a deal for a
Yeah.
longer period of time, then you will get into 35, $40 billion of CAD and say 10, $15 billion. Like FIs have already sold what, 18 odd billion dollars so far. And then FDI is also net negative. So your reserves get into a slightly tricky position. And the sentiment around it weakens as well. So I think those are the elevated levels of issues around the
Understood.
tariff.
Okay. So the second, so fair enough. So that is from the inflow, foreign inflows point of view, and also from currency perspective. The second point you mentioned was this big shift in government focus. I believe you're talking about taking a step off the investment cycle and pushing the pedal on the consumption cycle. Do you see it as a risk or an opportunity?
To some extent, Mahalakshmi, it is a risk because it reduces the potential GDP and transition takes time. Now, the central tenet of the problem is that centers plus state plus PSUs were driving a huge increase in capex spends. The idea that the government may have had was that if we do a lot of capex at start, it might crowd in a lot of private sector investment. The private sector capex, from at least what we see, is rising, but it's not the same intensity as pre 2015. And now the capex at the state and center level is slipping. That is a bit of an issue. Now, why is it slipping? Because the state governments, are promising poll freebies, which are far higher than what can be delivered. The ongoing Bihar elections, we saw one leader promise a job in every family. Right? There are close to 2 crore households in Bihar. The number of jobs, government jobs in Bihar are around 20 lakhs. The central government jobs are 48 lakh. If you total all central government jobs, all state level jobs, and all PSU jobs, even those total is not 2 crores. So they're announcing, and it's not just Bihar, right? We total the balance sheet of 16 states that went into elections recently, and you look at all that they promised, that number was higher than the capex bill. What they provided in their budget, thankfully, was less than half of what they had promised, but it still meant that it has come at the cost of capex, right? So that's point one. And in the seventh schedule of the Constitution, we run some responsibilities with the state, some with the center. What center can spend on is national highways, national railways, and defense. Everything else is state driven, right? And therefore, states assume a larger meaning in terms of capex spending. Even at the central level, we found that they pushed out capex possibly because they wanted to be fiscally prudent, or because that's only so much you can do in defense, railway, and highways, and large part of that is done. But irrespectively, capex was pushed out for 1 year. Now, if you total all the money that the state and center has given, we assume states have doled in something like 1.5 to 2 lakh crores. The center has reduced income tax by 1 lakh crore, and GST has been foregone to the extent of 2 lakh crores. So combined, you are talking 4 to 5 lakh crores, which is 1.3 to 1.5% of GDP. The impact and the problem areas, as we discussed, were twofold. First is that the capex intensity to GDP is far higher than RevX intensity or transfers intensity. By a report that I'm quoting the government on, the capex intensity to GDP was 2.5 times. So you spend 1 rupee on capex, the potential GDP increases by 2.5. If you spend the same rupee on revenue expenditure or transfers, that rupee increases by 1 time or slightly lower than 1 time. So net you have foregone 1.5 times of the 1.5% GDP that you moved from capex to consumption, and that means you've foregone something like 2.5, to round it off, potential GDP, which even if you look at it, the effect of it playing out in 3 years, you're talking about upwards of 75 basis point impact on the potential GDP, which is a higher impact than the tariff related issues that we'll have overall. Secondly, when you transmit an economy or when you transition an economy from capex to consumption, it's not a seamless transition, right? Because and China has been trying to do it for a very long period of time without a lot of success. The reason it takes time is because you don't really understand the preferences of how the people who get the money will end up saving, right? A lot of people who get the money might invest, might spend, or might just hide it under the mattress from a fear that they don't want anybody to know that they have this. So the M3 velocity of the money hidden under a mattress goes down to zero, and everything else comes into production. And regardless to say, it takes its time. And that time effect is what we are seeing in the corporate earnings. So, but as it relates to sort of the growth and the issues around the transition in the policy, these are the main sort of situations that we see.
Okay. Jigar, you said, during this whole bit, what I heard from you say is that the government is limited, the central government, I mean, state governments, you said, have a problem in terms of, how much headroom they have in terms of spending. But central government, you're saying that, in defense, railways and roadways, there is only so much that can be done. Are you saying that because of, because of this fiscal shift, essentially in how you spend, that will be capped, or is it because of anything else that spending will not go there? Because one option that the government can definitely exercise is to expand and go a little easy on the fiscal deficit, which will give you a little more headroom to do both. And an environment where we are bullish about our future growth, the markets can also perhaps arguably take this in their stride and say, as long as it is going to power public expenditure and capex, it's a welcome move. Do you think that is off the table?
No, Mahalakshmi. So I didn't make a definitive statement that is the intent of the government. I said that is a fact, that the capex has been pushed out by 1 year. Now, it could possibly be that because they wanted to be fiscally prudent, or it might be that there is only so much you can do in the capex around these three areas. Now, if you go back to the fiscal deficit sort of fine print, we did phenomenally well to reduce the deficit from 4.9% to somewhere around 4.4% is the budget estimate. Now, if you looked at the economist estimates back in that time, nobody expected it to go down to 4.4, right? All of them were at around 4.5. It looks like a tiny 10 basis points sliver, but in rupee terms, it is 50,000 crores, right? So if you added 50,000 crores to what the government had proposed, you would have come very close to 20% YOY growth. And the government's willingness to not cut that tiny sliver to capex is informative on many levels, right? So maybe that's only so much they can do, or they wanted to show that 4.5, not 4.5 and 4.4 would have been a statement in and of itself as well. So I think we don't really know what is happening. It's one of the two things, but we have come a long way as far as the central level capex is concerned. And I think that's where we are at. So don't know why they did it, but one of the two reasons, I would guess.
Fair enough. So we will talk about the implication from a stock and valuation perspective, between these two quarters. But before that, your view on, you mentioned flows that, even till today, even though FIs are selling, domestic flows continue to be very strong. In the next 1 year, how do you see this progressing? I'm asking this especially in the context of the fact that, retail investors, in fact, all investors chase performance. And if anything, in the last 2 years, markets have been pretty flat, although the correction happened last year, but last 2 year returns, the markets are more or less at the same place. On the contrary, our traditional quarters, which is gold, precious metals, silver, even real estate, there is a lot more optimism there, and gold is definitely shooting through the roof. Do you think there will be moderation in flows? Could that be a risk? Or do you think this is now in investors' psyche that SIP sahi hai or mutual fund sahi hai, and therefore this will continue to be a positive force?
So we can bucket sort of the flow question into two parts, Mahalakshmi. One is the domestic level that we spoke about, and we'll speak more on that. But the second is the FIIs, and if with your permission, we'll spend 3-4 minutes there. See, in the domestic side, if you take the total household financial savings in India, and of that, what's coming into equities is still only about 5.6% or thereabouts. We have come a long way from the 0.7% we had in 2014. And therefore, it might look like that, it's a lot already. But, most developed markets are upwards of 20%. US is upwards of 43%. Right? So clearly, if this is the direction we have chosen, then we have a long way to go. And if you pencil in something like 10% of total household saving coming to equities, and with nominal GDP rising and percentage of savings remaining the same, you're talking about 10 to 12 lakh crores of flows coming into equities from the 4.2 odd lakh crores we saw last year. So there is still a lot of room for us to explore on where this goes. The challenge is, as you mentioned, is that every asset class basis its recent performance is thinking about whether you need more allocation here versus there. By that logic, the deposit market share has not completely fallen off the cliff, and that gives one some hope that the domestic flow will likely continue. And historically, we had seen that if you had a return go negative over a 1 year period, SIPs used to stop. This time around, we are seeing continually strong SIP data, and that tells me that there is some fundamental shift that's happening, that equities as an asset class, people may be viewing that from the standpoint of it being finding a permanency in their asset allocation compared to all other asset classes. The second bucket is what's really happening with the FII flows. And, FIIs have withdrawn a little over close to $18 billion in this fiscal year. This has happened at the time when the dollar has depreciated against the wide array of currencies, which measured by the DXY index, has fallen from 110 to below 98 at its peak. In our last fact sheet, we put out the 35-year chart, which showed that whenever dollar depreciates, the emerging markets tend to do a lot better compared to the developed markets. It stands to reason because, if you are a global asset allocator, in the face of falling dollar, you would want to be outside that, so that when converted, returns look higher. But this time around, with dollar depreciating, money did move out. It moved out to Hong Kong, Taiwan, South Korea, but it didn't come to India. For a simple reason that on top of a depreciating dollar, rupee depreciated against the dollar. Right now, this hadn't happened. It doesn't happen often, but it does happen. And this time around, I think with all their wisdom, the RBI miscalculated the extent of FII outflows somewhere around September, October in 2024. So in September, October 24, you had almost 2 years of rupee being completely stable. And that may have given the perception that we'll be able to manage this FII outflows from a very thin margin. At their peak, RBI started shorting a lot of dollars in the NDF markets, no less. And peak position, which is not absolutely reported, but this is what we gauge from traders, reached almost $100 billion. On the base of $600-700 billion reserve, these are massive positions. And eventually, you will have to bring them onshore. The only problem is that when you sterilize those positions, you create a very large banking deficit. So the LAF window at its peak went down to a 3 lakh crore negative number. And then you had to do everything that was required to provide liquidity, right? You had to do CRR cuts, you had to do OMOs and the dollar swaps. And that gave a very confusing signal that eventually RBI doesn't have a handle. Because of that, I think FIs, that plus valuation resulted in FIs reducing their positions in India. But I think both of those issues are also behind us. Rupee, if under rare, is now back to its levels, and valuations arguably are a little more comfortable than they were a year back. So clearly, you have a situation where things look broadly okay from an FI standpoint, and domestic is what we discussed already.
Okay, so from a market standpoint, what are the sectors that you would stay away from, and what are the sectors that you prefer?
So if I bring this down before I answer your question, Mahalakshmi, to the state of the market, we are today at around 5.5 trillion, give or take, total market capitalization, of which promoter owns something like 50% to round it off. Mutual funds own 10%, FII 18%, and the retail about 15%. However, when you break this down, the top 250 companies, which is colloquially large and mid cap, FII positions are broadly nestled here, whereas companies number 251 all the way down, so small and micro cap, the retail ownership like to like is 3 times as much as FIIs. Right? They own close to 25 trillion rupees of stock versus 9 trillion rupees from the FIIs, and these are meaningful numbers. If the money is continuing to flow domestically and not, from FIIs, one might want to argue that small and micro cap will do a lot better than large and mid caps. But we have seen time and again that the fundamental predictor of stock price performance has always been earnings growth over longer periods of time. In the shorter term, these technical factors help, but over longer periods of time, if the earnings growth doesn't come through, then you sort of have a bit of a problem at your hand. Within the sectors, I think given the shift from capex to consumption, you're clearly having a situation where what was driving the market, namely say defense, capex, railways, those stocks might take a breather, and the new avenues of growth will come in the form of discretionary consumption. So two-wheelers, cement is a large discretionary consumption item. Pharmaceuticals look reasonably okay. Specialty chemicals look reasonably okay. And the aggregator of all of this is the banking financial. So insurance, non-insurance, and lending institution, all three look good to us.
Okay, Jigar, if you were to just summarize this whole thing and come back to our theme of Bach ke Rehna Re Blockbuster, what are the 3 or 4 things that you are saying we have to be cautious about?
The first part is that the
from a market, from a action perspective.
Right. The first part, Mahalakshmi, is that the tariff situations may take longer, which impairs the ability of the RBI to manage the rupee. We'll see 90 handles sooner rather than later. Secondly, the policy level shifts in India basically means that the traditional sectors that have driven market in the past 3 or 4 years may not continue to do that going forward. The third part is that with regards to valuations, the flows can drive the markets, but unless the earnings come through, which I think is the next section we'll discuss, you will not see a fundamental upward movement in the market. And the fourth part is with regards to flows at the FIs, that if rupee continues to depreciate, FI still is a larger cohort compared to retail. So I think these are the 4 points other than the earnings trajectory that we will come to in a bit. But these are the 4 points until now that one needs to keep an eye out on.
Okay. 1 or 2 last questions. First is, in the past 1 year, is there any new learning for you? Anything that taught you something new?
I think it's a continuous exercise, but yes. See, one of the largest learning we are having is that, you might want to think that because you can explain away a few performances basis short-term issues, the bigger lessons are learned when you break down the fundamental aspects of things, right? So the first principles. Now, if I take, say, a 5 or a 10-year rolling return, then the EPS growth and share price growth have always aligned, right? And if in September 24, for example, say exactly 1 month, 1 year ago, in September 24, the 3-year CAGR for small cap index was 2x that much as of the earnings growth on a CAGR basis for the small cap index. Now the argument was very simple, right? That if the domestics are going to power the small and micro cap, and FIs are powering large and mid cap, then FIs leaving and domestics continuing to pump more money would have meant that small and mid cap won't crack as much as large caps. And when the correction set in September 24, till December 24, BSE 500 was down about 5%, but the small cap index was higher than what was in September. But then when the relentless pressure continued, at its worst, the small cap index corrected 25% compared to a 19% drop in the BSE 500. Right? So that tells you that eventually you can make up all these theories and narratives, but the true fundamental predictor of the market is the fact that your earnings need to come through, your cash flows need to come through. And in absence of that, you might want to have a fun ride now and again basis flows, but those don't often end in a positive note.
True. That is the eternal truth in markets. One final question. What is your advice to investors for the coming year?
The advice is basically, Mahalakshmi, that we'll continue to learn together, because every day the market is teaching you something new. The investors, see, we had the Indian markets opened up in 92. Till I would say 2020, there were some 15 million active demat accounts. Post that, 65 million new active demat accounts have opened up. So a vast majority of investors have seen maximum two, but largely just one upward trending cycle. And therefore, there may have been some false notions on where the equity landscape truly is, right? If you take, say, a 5 or a 10-year rolling return, the earnings trajectory has been growing at 12%. It stands to reason basically that if your real GDP is growing at 6 to 7%, 2 to 3% is inflation, then nominal is at 10 odd percent. Nominal GDP includes agri, which is growing at a much slower pace, and therefore corporate earnings will grow at 11-12%. Over longer periods, as we mentioned again, the EPS and share price growth has always aligned. And therefore, in absence of huge flows, both domestic FIs over longer term, that is the extent of the returns that the market has delivered. For many investors, that might look like way too low today. The return that we saw post-COVID until September 24 was as a result of many things. The liquidity which was not there, earnings which had collapsed, and we saw all of that bounce through. Right? Earnings grew dramatically, new avenues opened up, money was gushing in, Federal Reserve, RBI loose policies. And the experience that was there between COVID and September 24 is not the new normal. The normal stays what has been for 5-10-year rolling return. And the returns expectation, if tapered accordingly, I think will drive a much structured equity markets going forward, Mahalakshmi.
Understood. Thank you so much for this lovely conversation, Jigar. Wish you a very, very happy Diwali to you, to your family, and the entire Buoyant family.
Thank you, Mahalakshmi. Wishing everybody, you, the Moneycontrol team, and all in your family the same. Let's enjoy this one together.
That's all on today's Blockbuster. Stay tuned to Moneycontrol for all your news and market updates.